Financial markets' nastiest surprises often come when something that is taken for granted is suddenly called into question, whether it's rising tulip-bulb prices, functioning banks, or a lockdown-free existence. Investors had a tough time in 2022 and lots of trends changed direction over the course of the year. Here were the top 5 most important reversals. In the 2010s, after the financial crisis, many people thought that interest rates would be near zero forever. Even in 2021, Schroders, a respectable UK-based asset management company that manages over $600 billion, published articles with titles such as The Zero, Why Interest Rates Will Stay Low. Ever since the global financial crisis in 2007-2009, the central banks around the world have been reducing interest rates to boost the economy. The COVID-19 pandemic ensured that the interest rates remained glued to the floor. Even the professionals thought that interest rates will remain there permanently. When the interest rates are low, people borrow more, and that's what happened over the past 10 years. The world added $80 trillion of debt around the world, which is an increase of 33%. So this is all the debt by everyone, including households like you and me, corporations and governments. But in 2022, persistent high inflation changed all that. America's Federal Reserve already increased interest rates by over 4 percentage points to 4.5%. This is the fastest pace of tightening since the 1980s. Other central banks around the world followed the Federal Reserve and did the same thing. Financial markets expect rates to stop climbing in 2023, with peaks of between 4.5% in Britain and 5% in America, and 3.5% in the Eurozone. But the odds of them collapsing back to nothing are slim. The Fed's governors, for instance, think its rates will finish 2023 above 5%, before settling down to around 2.5% in the long run. The era of free money is over. If the governments around the globe had to pay today's rates on all their existing debt, it would add $1.1 trillion to their budgets next year, according to Fitch ratings. So governments around the world will have to squeeze their spending on everything else to pay higher interest rates, or they should default on their debt. So tough times are coming. Also, it's probable that there will be a big financial crisis somewhere. Recent history is rich in examples of large debt piles that turned back. From Japanese corporations in the 1990s to US home buyers in 2007 and European governments in the following decades. Among possible weak spots now are the balance sheets of Canadian households, Italy's public finances, and private credit markets in the US. Pakistan, Sri Lanka, and Egypt are already discussing aid with the International Monetary Fund. There is a saying in the financial world: bull markets don't die of old age, they are murdered by central banks. That turned out to be right again in 2022, although the long bull run that ended had grown older than most. From the post-financial crisis depths of 2009 to its peak at the end of 2021, the S&P 500 index of leading American shares rose by 600%. There have been short-term interruptions to this upward march at the beginning of the pandemic, but markets recovered. But this time, it looks like market correction will probably last. The S&P 500 fell by a quarter to its lowest point this year in mid-October and remains down 20%. MSCI's index of global shares has fallen by 20%. And it's not just stock markets. Bond markets have also corrected by 15 to 20% around the world. Even if the prices don't fall further, the idea that there is a bull market in everything has come to a close. In the past decade, capital was not just cheap, it was also seemingly everywhere. Central banks' quantitative easing programs, devised during the financial crisis to stabilize markets, went into overdrive during the pandemic. Together, the central banks of America, Britain, the Euro area, and Japan have created new money worth $11 trillion and used it up to buy safe assets such as government bonds and depress their yields. So investors were forced to invest into more speculative corners of the market in search of returns. which in turn caused these assets to rise. During the 10 years prior to 2007, American firms issued $100 billion of the riskiest high-yield debt or junk bonds a year. During the 10-year period between 2010 and 2020, however, they averaged $270 billion per year. In 2021, they hit a record of $486 billion. Similar story for initial public offerings, which smashed all records in 2021, raising $655 billion globally. But now the Federal Reserve and the Bank of England have put their bond buying programs into reverse. The European Central Bank is preparing to do likewise. That is causing liquidity to drain away. This year, junk bonds issuances have fallen by 3/4 to about $120 billion. Now, American IPOs are set for their leanest year since 1990. The value of mergers and acquisitions has fallen too, but less dramatically. Capital abundance has turned to capital scarcity in the current markets. Here's why growth stocks went out of fashion. With rates at 1%, to have $100 in 10 years' time, you must deposit $91 in the bank account today. With rates of 5%, however, you need only put away $61. So the value of $100 promised in 10 years is now worth $30 less, from $91 to $61. Growth stocks such as Tesla, Meta, Netflix, Amazon, etc. that promised explosive future profits and that were trading at high prices compared with their current earnings, which were often non-existent, fell massively as interest rates rose. Meta, for instance, fell by 70%. Peloton fell by 90%. So suddenly everyone wants to invest conservatively. Hence the interest in value investing, which is about investing in stocks that are cheap relative to their underlying earnings or assets. The bull run of the past 10 years was a dispiriting time for value investors, as everyone was taking risks fueled by low interest rates and quantitative easing. From March 2009 to the end of 2021, MSCI's index of global growth stocks rocketed by a factor of 6.4, more than twice the increase in the equivalent value index. This year, rising interest rates turned the tables and value investing is back in vogue. All those who argued that crypto is good for nothing but gambling and dubious illegal activities could not hope for a better case in point than the fall of FTX. The crypto exchange was also supposedly the industry's respectable face, run by Sam Bankman-Fried, a 30-year-old philanthropist and political donor. Yet, in November, the firm collapsed into bankruptcy with some $8 billion of customer funds missing. American authorities now call it a massive years-long fraud. Mr. Bankman-Fried now faces criminal charges. If convicted, he could spend the rest of his life in jail. FTX's downfall marked the busting of crypto's most recent bubble. At its peak in 2021, the market value of all cryptocurrencies was almost $3 trillion, up from nearly $800 billion at the start of 2021. It has since fallen back to around $800 billion. Like so much else, the affair's roots lie in the era of cheap, abundant money and anything goes mentality if created. In the 1960s, growth stocks staged a big rally, with 50 of the top growth companies in cutting-edge industries like technology and pharmaceuticals becoming so popular that they were called the Nifty 50. The Nifty 50 were considered sure things, which led willing investors to pay as high as 50 times earnings to own the stocks, under the belief that those innovative companies would keep growing at a fast pace forever. In 1969, Buffett found nothing of value to buy, so he dissolved his investing fund and moved to the sidelines. But the party finally ended in 1973 as the Arab oil embargo, another instance of a recession followed by inflation that ripped through the world's global stock markets. When the sell-off was over, the Dow had fallen by 45% in 2 years. Suddenly, there were many value stocks and Warren Buffett came back into the game, this time as CEO of Berkshire Hathaway. Like Warren Buffett said, I'm paraphrasing here, history repeats itself in the financial market and new investors will learn old lessons after kissing goodbye to their money. 2023 will only get worse for these investors. Thanks for watching. This is Sharath Mantravadi and please consider subscribing and wish you a happy new year.